Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, September 9th at 2 p.m. in London. Queen Elizabeth II passed away yesterday. She was the only monarch most in Britain have ever known, a steady constant over a period of enormous global change. She defined an era and will be missed. The eyes of the world are now turned to the United Kingdom, and they do so at a time when the country is facing an unusually high level of uncertainty. The UK economy, which was recently surpassed in size by India, is still the world's sixth largest, but it's currently being buffeted by a host of economic challenges. Some are domestic, some are international, but combined, they create one of the trickiest stories in the global economy. First among these challenges is inflation. Rising costs for energy have driven consumer prices in the UK up 10% year over year. But even excluding volatile food and energy, UK core inflation is still over 6%. And elevated inflation is not expected to be fleeting. Market-based estimates of UK inflation over the next 10 years are the highest since 1996. Those elevated prices have driven UK interest rates higher, but even so, UK rates relative to inflation are still some of the lowest of any major economy, which makes holding the currency less attractive. That has weakened the British pound, but since the UK runs a current account deficit and imports more than it exports, imported things have become more expensive, creating even more inflationary pressure. The UK's decision to leave the European Union, its largest trading partner, is another complication. By restricting the movement of labor, it's created a negative supply shock and increased costs. And it has increased the friction in trading abroad, especially with Europe, making it harder for UK exporters to take advantage of the country's weaker currency. The response to all this high inflation will likely be further rate hikes from the Bank of England. But this has the potential to feed back into the economy unusually fast. Over here, many student loan payments are tied to the Bank of England rate, and the rate on UK mortgages is often fixed for only 2 to 5 years, in contrast to the 30-year fixing common in the United States. That means the impact of higher interest rates into higher mortgage costs could be felt very soon. For UK assets, the fact that a 10-year UK government bond yields less than a 6-month US Treasury bill and yields much less than UK inflation creates poor risk-reward. The pound could continue to weaken, given all of these economic challenges. But one bright spot might be the equity market, the FTSE 100. Trading at about 9 times next year's earnings and benefiting from a weaker currency as many of these companies sell product abroad, we forecast stocks in the UK to outperform those in the Eurozone. Thanks for listening. Subscribe to Thoughts on the Market on Apple Podcasts or wherever you listen, and leave us a review. We'd love to hear from you.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.